All right. So I think I'm starting to record the class. So even if others will join later, they can get the recording. So good morning, everyone. I hope you can
Good
see
morning,
my
sir.
screen.
Yes, sir. You can see it.
Because okay. Thank you. All right. So my name is Jimo Olalekon, and I'm one of the tutors for this paper. Uh, so without wasting so much time, I will go right into the paper. So this is Corporate Strategic Management and Ethics, CSMA. Fine, I don't know what you have done before. I don't know the extent you have gone, but I will try to, build a foundation as well so that you can follow through with me. All right. So the syllabus is divided into four parts, and these are the parts. We have the strategic management, risk management, corporate governance, and ethics. Right. So, what is strategic management? Usually, businesses survive based on the plans that they make. Right. Just like the usual saying that if you fail to plan, you have already planned to fail. So, corporate strategic management is how long-term goals and objectives of an organization are being managed and monitored and implemented. Right. So it's basically about long-term planning of an organization. Okay. So yes, many businesses cannot survive without it. Okay. And when we talk about um, risk management, right? So there are certain businesses. So let me give you an example. Um, you know, um, because of the harsh economic environment of Nigeria recently, and prices are going up, some business might want to diversify, right? But before diversifying, they have to consider those things that could go wrong in the new business they are diversifying into. And those possible things that could go wrong are known as risk. So this risk must be identified by those who manage the business. I mean, the board of directors. So they must identify this risk and look for a way to manage it. I mean, to reduce the possible impact of this risk on the business, and that is risk management. So the other part of it is the corporate governance. Now, the corporate governance is more like, yes, businesses, there's this idea that ownership and control must be separated. There are various reasons. One of the reasons is that for public complaints, complaints who have sometimes they could have thousands of owners, shareholders. So you want to wonder how these owners can come together to manage the business, right? Fine, it will be impossible. Of course, some of them might not even have the time, right? Some of them do not have the required skill to manage large businesses. So there is need for this thing they call separation of ownership from control. So they want the owners to be separated from those who control the business, those who manage the business. So once that is done, that means the owners will be on one side and those who control the business will be on the other side. Who are those who control the business? They are called the board of directors. So they are being given the power to and resources to manage and control the business. So the issue now becomes, how will the owners know about how these people are managing the business? Right. Okay. So they now designed a particular model which is known as corporate governance. Corporate governance is more like a process, the system by which large businesses are directed and controlled. So if there are policies that have been made, if there are guidelines that have been made that this board of directors must follow, so these policies, these guidelines are known as corporate governance, and that is why you see code of corporate governance, right? So we look at that later. Then the last part of this paper is ethics. So ethics is usually is related to how businesses, what businesses should do and should not do. Okay. Although on the other side, it is applicable to accountants. So what businesses should not do? Businesses should not engage in unethical business practices like cheating, you know, cheating, dishonesty, you know, and for all sorts of bad things that could damage the reputation of a business, that could damage the integrity of a business. So they should not engage in it. Likewise, accountants should not engage in those things that could damage the reputation of the accountant. Okay. So you can now start to wonder that, right? We are becoming accountant. So how are these things how are these things I've mentioned above? How are they applicable to me as an accountant? Yes. So for corporate strategic management, I told you that is where plans, long-term plans are made. But before long-term plans are made, there is need for financial data. So who will supply this financial data? Yes, it's you as an accountant. So there's need for you to understand what strategic management is so that you can know how to work with them in order to supply the data they need for making such plans. Then when we talk about risk management, so one of our job as accountants and as auditors is to be able to work in the internal control, to work out internal control policies, processes that will help to mitigate risk. Okay. So if you do not understand what risk is or how risk can be managed, it will be difficult for you to identify risk and even provide, control measures to mitigate the impact of this risk. Then we could talk about the corporate governance. Yes, I said corporate governance is just the way businesses are managed and controlled, right? And there are codes that guide this corporate governance. There are codes that guide the behaviors of the board of directors. So one of those things is that the directors must be transparent and must be accountable to the owners. So how can they be accountable? They need to prepare financial reports. Now, this financial report must show the true and fair position and performance of the business that they are managing. And that is where you, as an accountant, come into play. So you have to contribute into the corporate governance of an organization. You have to prepare accounts that align with the international financial reporting standard, that align with uh, you know uh, generally accepted accounting principles, right? And it must be fair. It must show the true and fair position and performance of an organization. Then we could talk about ethics. How is ethics applicable to you as an accountant? As an accountant, you have to conduct yourself in such a way that you have to uphold high ethical standards. So the Institute of Chartered Accountants has prepared certain code of ethics for we as accountants. So you have to position yourself in that code. You have to uphold that code, right? And that will push you as a professional accountant. And the other side is that for businesses, you must not collide with with the board of directors, with the management, to manipulate the accounts that are to be provided or are to be prepared and submitted to the shareholder, to the owners of the business. You should not engage in such practice, and that is why you have to be aware of this of what ethics is, even as to businesses and as to you as professional accountant. These are just background. So today we are going to look at risk management. We are looking at risk management. Okay, and there are two chapters that deals with risk management. The first chapter is chapter 9, that talks about the that treats the identification and assessment of risk. So under that chapter, we look at how you look at the nature of risk, what risk is, how can you identify risk, and how can you assess risk. Okay. Then the other part of it is controlling risk. So once you have identified the risk, risks are not just meant to be identified. You have to look at ways by which you have to reduce the impact, the possible impact of the risk on the organization. And that is what we call risk management, or how to control risk. So there are various methods by which you can use to control risk. So today, let's look at how to identify and assess risk. Okay. So how can we identify and assess risk? So under this topic, we are looking at four basic things. We are looking at risk and risk management. We are looking at categories of risk, concepts in risk management, and identification and assessment and measurements of risk. Okay, I hope we can finish all this today. Right. Okay, so what is risk? What is risk? So in simple terms, risk is just the idea that when you are planning to do something, even as individual, when you are planning to do something, and in your mind, you will feel like, oh, what if I fail? What if a certain thing happen and this plan fails? Right now, that what if, that particular thing that could happen that might make that plan to fail is the risk in that plan. So risk can be said to be the possibility that things might go wrong, the possibility that a particular event, a particular plan, a particular objective might turn out worse than expected, or that something bad might happen. That is risk. That is risk. Now, I have three stories that we that we that will show you, that will explain to you the nature of what risk is. Okay, so there is this story about you know, even you as that relate to accounting students, that relate to ICANN student. So Tunde is an ICANN student. Is planning to write ICANN exam. Okay, so as the exam is approaching, there are certain issues that could come up that could make Tunde to fail the exam. Now, one of the issue is the pressure and anxiety that accompany high stake exams, such as ICANN exam. Pressures could come in form of stress. You have to manage reading and work. You have to even those who are married, those who have family, they have to manage work, they manage family, they manage the exam, they engage in studying overnight and all that. That pressure, if not well managed, could result into sickness. Okay, right? I don't want to read it, I want to explain the story. So could result into sickness. Okay, and if Tunde falls sick, That means Tunde will likely not be able to write the exam, and Tunde will fail in becoming a chartered accountant. You see, that is a risk there. Now, the other risk is that the unforeseen personal challenges, okay, possible if there is a family emergency that will deprive Tunde of studying. Maybe a family member, you know, had an accident and Tunde had to be present there. Tunde had to stay with the person. Maybe there's need for a particular family member to be cared for, right? So these unforeseen personal challenges could also deprive Tunde of his time to study, to prepare very well. Now, these unforeseen personal challenges you know, is also a risk to Tunde in passing his exam and becoming a chartered accountant. The other risky issue could be financial strain. I'm sure you all know the costs, all the associated costs to to becoming a chartered accountant. Yes, you have to pay for, you start by registering, you pay for exemption, you pay for exams, register for lectures, you buy materials. Fine, I can will give you certain materials, but some of you will want to buy extra material. Now, all of these costs, if someone is not well prepared, right, or is not well supported financially, will likely drop out of the ICANN exam, right? So if you don't have money to attend lectures like this, how can you prepare effectively? If you don't have money to register for exam, how can you write the exam and become a chartered accountant? So possible financial strain is also a risk that Tunde will identify. Now, the intricacies in time management is also another risk, because Tunde have to manage the time he will use to work in the office. Possibly Tunde is working in Lagos, and Tunde will have to go to office by as early as 8 a.m., return, close at the office maybe 5 p.m. or maybe later, and we have to travel from the office again back home, right? And by the time Tunde gets home, Tunde is already tired. Tunde cannot read for that day. Okay, so that means Tunde, we need to look for a way to manage the office and the preparation for exam. Of course, if Tunde fail to do this, that means Tunde will not be able to prepare for the exam, and Tunde will likely fail for the exam, and Tunde will not become a chartered accountant. Okay, so these are possible risks. So let's assume Tunde is starting out in planning for his ICANN exam. These are the possible risks that he would have identified them while planning, while making his plans. And the next thing will be that, how do I work out these things so that I will eventually write the exam and pass the exam? So that is the other side of what we call risk management. Right. That is the first story. So I don't want to go into the other ones, but the other one, this particular one is in relation to the Japa syndrome in Nigeria presently, right? So it means that when you are planning to Japa, that means you also have to identify certain risks that could make the Japa to fail, right? Now, one of the risks could be that the risk that you might not even have enough fund to travel in the first place. The risk is there. And that is why you see many people take huge loans to travel out of the country, right? The complexity in the working environment in that country that you are going might pose another risk. If the working environment is not favorable, if it is toxic, if it is what you find difficult to adapt with, that means you might not be able to work there. That means you might not be able to stay there. And that means the jackpot has already failed. What about the weather condition? What about the weather condition? What about the risk that the job you have to do there, you might not be able to handle them? What about the risk that your family that you have left at home, they might be pressurizing you to come back for them? If they do so, that means you will likely not be able to stay in the new country, and you have already failed with your jackpot plan, right? So you can read the other the other story later. But in other words, these are the different ways by which you can identify risk. Okay, so this is what risk looks like. The possibility that something might go wrong in that your plan, whether in business, whether in personal life, whether in professional life, in whatever thing, there's risk. Risk is involved in everything. Of course, we say it in our daily activities that if you want to do something, there's risk in everything. No, you can, yes, there's risk in everything, right? So that is the nature of risk. In fact, the International Standard Organization define risk to be the effect of uncertainty on objectives, the possible effect of what you are not certain of, those things you don't know about, those things that could go wrong on your objective. That is risk. Okay, so now there are when I'm starting out explaining risk like this, I want everybody to get the idea. I want everybody to get the idea first. So there is this Bible verse, 1 Corinthians 16:13, that I also use to explain risk. And the Bible verse says that, be on the alert, stand firm in faith, act like men, and be strong. Okay. Now this passage was written by Apostle Paul to the Corinthians. Apostle Paul used to be someone who hates Christians, who hates those who preach Jesus Christ, right? But he was met with Christ, and he also became someone who is preaching Christ. Now, after becoming someone who is preaching Christ, he usually persecutes those who preach Christ. So after becoming one himself, then he now champions teaching other countries, other people, how they should go about being a Christian. So so he wrote a letter to the Corinthians, right, telling them that now you have accepted to become a Christian, you have accepted Christ. Now I'm telling you ahead, I'm warning you ahead to be on alert. There are dangers. There are a lot of issues that could go wrong when you become a Christian. He's warning them ahead. He's telling them that those are the risk, those possible issues. You could be persecuted, you could be stoned to death. And because you are a Christian does not mean you will not be challenged. Issues will not come. No. So you have to be on alert. You have to stand firm and act like what? Act like men and be strong. So he is telling them that there is risk in being a Christian. There is risk in being a Christian, right? And you can read up on that later. Then the other Bible verse is 1 Samuel chapter 4 verse 9. He says that, take courage and be men, O Philistines, or you will become slaves to the Hebrews. as they have been slaves to you. Therefore, be men and fight. Now, the issue is between there was this war before between the Philistines and the Israelites, right? And the first war they had, the Philistines won, and they took some of the Israelites as slaves. Okay, so another war is coming. So the Israelites, because they believe so much in the Ark of Covenant, they now went, they now call for the ark, that it should be brought from Shiloh, that they are taking the ark to the war, so that they believe that the ark could help them to win the second war. They fought the first war, the Philistines won them. So they are now planning to take the Ark of Covenant to the war. Now, the elders in the Philistine haven't heard of the plan of the Israelite. They were now charging their youth, their people, that, oh, you Philistine, you have to take courage and be men, or you will become slaves to the Hebrews. The Hebrews, maybe the Israelites, as they have been slaves to you, because we took them as slaves during the first war. So the risk there is that the risk in this war is that we do not want to become slaves. We do not want to become slaves. So you people should stand up and fight. Fight with all your might and strength. Okay, so again, this Bible verse is telling us that there's risk everywhere. Okay, and that is the nature of risk, the possibility that something negative could go wrong. Of course, later on, we will see that risk is not just about negative things. There could be positive in risk. This could come in form of positive issue or positive outcome. Okay. All right. So let's look at the broader meaning of risk. So risk also exists. Now, let me give you an instance. So if you plan to if you plan to invest in a particular business now, let's say you want to invest in Uber, for instance, right? Uber business, you want to start driving Uber cars, right? You know, there's possibility that you could be profitable in that business, and there's the possibility that you could incur loss. So I was reading a post on Naira Land recently, and someone was saying that he just started his Uber business, and he was narrating that he bought a fuel level about 24,000 naira, and at the end of the day, he could not even make up to the he could not even make 20,000 out of the 24,000 fuel that he bought, talk less of getting excess, I mean making profit. So he had made losses like 2 3 times, right? So now, so risk, it means that risk also occur, or risk could exist when there is when the outcome of a possible event cannot be predicted. That is, when there are two or more possible outcomes of a particular event. Okay, so event could either be positive or negative. So that is a broader meaning of risk. You know, I told you the other time, risk could be positive, it could be negative, right? But whenever the future outcome of a particular event cannot be predicted, or when there are possible outcomes, that is also that is another meaning of risk that we have to be aware of, right? So there are two major categories of risk. We have the pure risk. We can also call it downside risk, internal control risk, or operational risk. And we have the speculative risk. It could be called business risk, enterprise risk, strategic, or we could call it two-way risk. So what is pure risk? What is pure risk? So pure risk is when there is possibility that an adverse event, the possibility that an adverse event might occur. That is pure risk. An adverse, a negative event might occur, right? That is pure risk. Now, this means that event can only be worse than expected and cannot be better, right? That is what pure risk means. That is what downside risk means. It means that it means that there is only one outcome, which is what? Negative outcome in pure risk. There's only negative outcome in pure risk. Now let's look at a very good example is a manufacturing company. Let's look at this example. A manufacturing company that relies heavily on single supplier for critical components used in their product. Now, there is a risk that the supplier may experience production delays or supply chain disruptions, which could lead to a shortage of components and hinder ABC Electronics' ability to meet up with customer demand. Now, the expected outcome is smooth and uninterrupted supply. They just want to get the supply from their supplier. That is their expectation. But there is possibility of such what disruptions. Disruption could exist. There's possibility of disruption in the supplier's value chain, which will which will also affect what? ABC Electronics in doing what? In meeting the demand of its own customers. That is it. So in downside risk, in pure risk, in internal control risk, in operational risk, it's only about when there is possibility of negative outcome. There is only one outcome, it is negative outcome in pure risk. Okay, so we could talk about the speculative risk. We also call it two-way risk or business risk. And that is when there is possibility of different outcomes. When there is possibility of different outcomes, that is when the outcomes could either be what? Be positive or negative. When the outcome of a particular future event could either be positive or negative. Now, an investor in shares will be exposed to what? To speculative risk, because when the share the investor has purchased could either the price of the share could either go up or come down. So if the share goes up, right, that means if you want to sell and the share is up, that means he's selling at profit. He will make profit. And the share could go down. If the share goes down below the purchase price, that means, and he wants to sell, that means he's selling at what? At a loss. So he's exposed to speculative risk. Speculative risk is when the actual future event might either be better or worse than expected. Is what? When the actual future event or outcome of future event is either what? Better or worse than expected. That is speculative risk. I have various examples of speculative risk here. You know, the first one here, a restaurant that plans to have a new menu rather. you know Maybe some people have been demanding for the new menu, right? So the owner decided to invest and prepare that new menu. The new menu will face speculative risk, and the speculative risk will come in form of the customers may like the new menu. If they like the new menu and more of them are coming to buy it, that means they will be selling at profit. Of course, if you know it's a new menu, if they do not like it, if this does not go with their taste, that means they will incur loss on preparing that new menu. Okay, that is a very good example of speculative risk. Now, the reality is that companies face both the pure and speculative risk. They face both the pure and speculative risk because because most of the time negative things could happen in most of the things that they do. And most of the time as well, businesses always try to do certain things in which they put money into. They go into different sort of investment. They could invest in people, they could invest in plants and machinery, they could invest in they could diversify, they could go into a new investment entirely. Okay, all of this will affect the business, right? However, pure risk pure risk are risks that can often be controlled by means of what? Internal controls or by insurance Now, the example of the ICANN student, the internal controls will be that he will try to work out certain measures to manage his time. He will try to work out certain things that will help him to raise funds to finance his ICANN professional examination ambition, or becoming an ambition of becoming a chartered accountant. He will try to look at different ways by which he can manage his time properly. And when it comes to businesses, the other example I made about um, the other example about the I made an example the other time about a business that is, sorry, please. Okay, so in terms of business, okay, I made an example about okay, maybe I didn't say anything about it, but there's this example about when when a machine could result into an accident, when an accident could occur, right? That is a downside risk, okay, and a staff could be injured. So the internal control would be that the staff using the machine could be trained. They will finance trainings for them so that they know everything about the machine. There are different measures that will be put in place so that that accident will be minimized. Of course, if there is an accident, in order to minimize the impact, they could be insured. The company could get insurance for the employees. Okay. Okay. So therefore, business decision taken by management could involve both business risk and operational risk or downside risk. So let's look at the nature of risk management. The nature of risk management. So what is risk management? Now, just like I said the other time, when you are venturing into a business, when you are having a particular plan, and the first thing is to plan about the business, right? While planning about the business, that is when you will identify the possible risk that could make the business to fail or that could make your plan to fail. That is risk identification. After identifying the risk, there will be need for you to now say that, okay, what will be the impact if this risk that I have identified materializes? What will be the impact? If an employee is injured, what will be the impact of the risk? That is risk assessment. We want to assess the risk. We want to look at the impact, right? So the impact could be that if an employee is injured, that means the company we have to bear the cost of taking care of the employee. You know, that injury could also result into legal action by the family of the employee, and it could result into the company paying fines, being fined, right? Okay. They will incur legal cost and legal fine, right? Apart from even taking care of the employee, right? So that is possible assessment of the impact of the risk. Then when you have identified the impact of the risk, then the next thing will be that, oh, if there is this possibility that these things will happen and we will incur this much cost, that means we have to we have to look at ways by which we will minimize the impact of this risk on the business. Okay. Okay. So all of this process, starting from risk identification, risk assessment, we could talk about risk measurement, we could talk about uh, uh, categorizing risk into different categories, and risk mitigation or risk control. All of this process is what is known as risk management. It means that your job is not to only identify risk. You have to look for ways by which you will mitigate the risk. There is a process by which you can do that. So risk management is a process of managing both, well, downside risk and what? And business risk. It is the culture, structure, and processes that are focused on achieving possible opportunities, yet at the same time control unwanted results. Control unwanted results. That is the nature of risk management. Okay. Now, the question now becomes, in organizations or in public complaints, because because there are guidelines, there are rules that mandate public complaints to always report on their risk, on the risk facing the business, and how those risks have been managed, or how they intend to manage those risks. There are requirements for that, right? So the question becomes, who should be responsible for risk management? Who should be responsible for risk management? Yes, the set of people that should be responsible for risk management are, I was talking about the separation of ownership from control of of large corporations, of publicly traded corporations or listed companies. And I said corporate governance is the set of principles, rules, and regulations that have been established to guide the conduct of the board of directors. Of course, we will do that later. I'm just trying to build a connection. So, part of the code of the corporate governance states that the board of directors should be responsible because the owners have invested their funds, their life savings in the business. Their life savings can be said to be the equity of the business, or you say capital of the business. Now, this capital have been invested in assets, in purchasing land, buildings, machines, and all that, and equipment, and inventories, goods and services for the business. So it is the responsibility of the board of directors to do what? To protect the company's assets so that it will not be exposed to what? To loss. Now, protecting it means that they have to they have to identify those things that will make the business to lose the funds invested in it. So let's assume that part of the fund that has been invested in business, the directors now intend to diversify into another business, right? They are using the fund. Okay, it means that they are responsible to identify those risks, the risk involved in that diversified investment. Those risks that could make the new investment fail, they have to identify. They are responsible for it. So that means that the responsibility for risk management lies on the what? On the board of directors. They set limits for risk. They have to say that, okay, this is the limit, because the management team reports to the board of directors. So the management team are the ones that will make day-to-day decisions of the business, right? So they are at the board level. The board will make risk policy. Okay, this complaint, we are taking risk, but the level of risk we are taking is, let's say, 15% risk. Anything that goes above that, we are not going. Any business, any investment, any decision that the risk is above 50% is a no-go area. So they are the one that will set the tone at the top. Okay, now there are various reasons. Why the board are is said to be responsible for risk management. The first one is the Cadbury report in 1992. The Cadbury report in 1992, right? So, why was the Cadbury report? Now, there was this issue of a business. The business is called the is called the what's this business? Max Communication. And the owner of the business was busy doing, taking over more business, buying more businesses and all that. And he was basically using the pension fund kept by the business. He was using the fund in doing some other businesses. So in 1990 or thereabout, Maxwell, who is the owner of the business, died. And after his death, all of the shady business practices that he has been engaging with, he engaged himself in and the business in, everything just opened up. And in about 1992, in 1991 or thereabout, the business was declared bankrupt. And not only that, some other businesses were also declared bankrupt alongside the Maxwell Communication. So the government in the UK now set up a committee known as the Cadbury Committee to look into the reasons why these businesses are failing. And from that committee, they came out with a report known as the Cadbury Report, which was issued in 1992. And that report, one of the things that the report came out with was that the process by which the executive management, under the board's supervision, identified the risks arising from business. That is risk management. That is, they are talking about that the board should have a process in place. They should have a process in place by which they identify those risks that will be arising or that are arising from the business operations. And now they can be managed or how they should be managed. They should identify it. The board should be responsible for it. And they are saying that that is one of the reasons why these businesses have failed. Now, the other reason why the board is responsible for the risk management is the ICGN corporate risk oversight guidelines. The ICGN is the International Corporate Governance Network. I mean, that is one of the bodies that sets the guidelines, that make guidelines for corporate governance in the in the world. And that is where most of the companies adopt. That is those guidelines are those guidelines that companies adopt in formulating their own corporate governance guidelines. So they also said that the that the responsibility for the oversight and management of corporate risk lies on the what? Lies on the what? The board of directors. The board is responsible for deciding the company's risk strategy and business model. They also support it. They also support it. Now, the other reason is that when we come down to our local environment, the Securities and Exchange Commission in Nigeria, a commission that regulates the exchange of uh, you know that regulate the capital market, also said that that the board may establish a risk management committee to assist it in its own oversight of risk profile, risk management framework, and risk reward strategy determined by the board. This means that they also said that the board should be what? Should be responsible for risk management. Now, the Financial Reporting Council of Nigeria also issued Code of Corporate Governance and says that the board should undertake at least annually a thorough risk assessment that should cover all the aspects of the business and ensure that these company risk management policies and practices are disclosed in the annual report. And that is why today, when you open the annual report of of publicly traded companies like the Dangote, most of these banks, when you open the annual report, you also see their risk management report. You see risk management report in their report. Okay, so these are the reasons why the directors should be responsible for risk management. Now, the other thing we are going to be looking at is risk management and internal control. We want to look at the relationship between risk management and internal control. So, what is internal control? Internal control relates to various policies, procedures established to provide assurance that the objectives of the organization will be achieved. Okay, so those are it's just a system whereby policies are formulated so that objectives will be achieved. Let's take for example, we have identified that we have identified that uh, you know um, we identified that certain things could go wrong in a business. Maybe we have identified that there's possibility that the employees might be they might engage in stealing the company resources, maybe inventories. Yes, that is common. So the management could come up with certain policies that will ensure that that will not happen. Fine, they might say that, okay, they could issue a policy that when you are taking any complaint resources, right? When you are taking any complaint things, it must be registered in your name. So maybe you must register that thing with the HR. So the HR will take note that so person has taken this particular thing. So when we are looking for it, we are coming to meet you. So that is an example of internal control. It's just when policies are made to ensure that resources are not being wasted and businesses will achieve their objectives. Now, what is risk management? Risk management involves identifying, assessing, and mitigating risk that could affect an organization's ability to achieve its objective. Okay, so what is that relationship between internal control and risk management? The first thing is the identification of an assessment of risk. So risk management is where risks are being assessed and and where risks are being identified and assessed, and you know so when they are being assessed, now internal control is what we now design policies around that risk so that that risk will not materialize. So that is the relationship. Risk management, we identify the risk, we assess it. But risk control, I mean internal control on the other hand, we formulate policies around that risk that has been identified so that it will not materialize. Monitoring and evaluation. So both the internal control and risk management, they engage in what? In monitoring and controlling risk. They monitor risk. And that is why internal audit, one of the function of internal audit these days is to do what? Is to monitor and evaluate risk. So both risk management and internal control engage in what? In monitoring and evaluation of risk. They also both also will be involved in communicating and reporting risk to those in charge of risk management. Who are those in charge of risk management? The board of directors. Okay, so that is the that is the relationship between risk management and internal control. Okay, so the other aspect is that the Turnbull guideline, also known as the Turnbull report, talks about the risk risk or internal control. It talks about the internal control. So after the report, after the Cadbury report in 1992, so the Turnbull committee was also asked to look at ways by which risk can be managed or controlled. So these are the aspects of the Turnbull report. I mean the guideline of Turnbull report. So it states that it talks about internal control. You know, it talks about internal control that there should be a whole system of internal control that will help in mitigating risk. It also talks about risk management. It talks about risk management that there should be a process in place for risk to be managed. And you remember I talked about risk management as a process of identifying risk, you assess it, and you monitor it and you mitigate it. Right. So there should be the Turnbull guideline is saying that. I mean, the Turnbull guideline is just like a more detailed guideline on risk management after the Cadbury report. Okay, so it's talking about there should be a process of internal control. There should be risk management control, and there should be control environment, right? So the control environment should include a situation whereby the board should set the tone at the top. They should make the they should set the tone, they should set the example, they should give the order to the management team on what should be done as regards risk. There should also be control activities. That is, certain activities should be put in place in order to identify, you know, I mean, control activities should be put in place to mitigate the possible impact of those risks that have been identified, which could include segregation of duties, authorization and approval procedures, physical controls, and information system control. The control activities, it could be it also include that uh, the control activity could include that the same person should not raise the same person that is raising a voucher should not be the same person that will sign it. That is a form of control activity. Okay. Then information and communication should be part of the risk control process. Okay. That is, each part of the organization, each unit of the organization should communicate risk information to the appropriate authorities so that they can make the required and they can take necessary action against the risk that have been identified. And there should be monitoring of risk. There should be monitoring of risk. And the idea is that risk will change. A risk that you have identified today because of changes in business environment could vanish. The risk will vanish and new risk will come up. Recently, you will see that there is continuous increase in prices of food, goods and services. That is market risk. Okay, so that is like a new thing recently because the prices are going up constantly, right? So it has to be monitored. Some risk might go off. The risk that employee might be injured, the risk that employee might be injured might vanish at some point if they are all experienced, if they have been trained. That risk might vanish and another one might come up. Okay, so that is the reason why risk must be monitored. Okay, so let's look at the elements of a risk management system. Let's look at elements of a risk management system. Now, the first element is that there should be a culture of risk awareness in the company or within the company. Everybody, right from the board down to the management, they must be aware. They must be aware of those risks that could impact on the business achieving its objective. There should also be a system in place that will identify risk, assess it, measure it, and control it. There should be a process in place that will help in identifying, assessing, and measuring risk. There should also be an efficient system of communicating risk information to those in charge of risk. Who? To the board of directors. To the board of directors. And there should be strategies. There should be strategies and risk should be monitored. There should be strategies for monitoring of risk. These are the elements. These are the various elements of a risk management system. Now let's look at how corporate organizations organize for risk management. how they organize for risk management. So, you know, because the responsibility of the risk management lies on the board of directors, right? And most of the time, the board are seen or are usually engaged in so many things, because they do research, they make plans, they do virtually so much. And if they now also take the burden of risk management, they might be lacking in that aspect. So what they normally do is that they normally they normally establish what they call risk committee. They usually establish a risk committee. Okay, they establish a risk committee whereby those people, they bring together different people who are experienced in risk management, right? Which is usually shared by the CEO to monitor, to identify risk, monitor it, and coordinate risk management activities. So this is one of the ways by which corporate organizations make arrangements for risk management. They do that through risk management committee. Okay, so let's look at the various types of risk that are common to many businesses. The reason why we are looking at the common ones is that risk are most of the time related to different businesses. Risk are peculiar to businesses. So it is your kind of business that will determine the type of risk that you will be exposed to. But these are the sort of risk that many businesses could be exposed to. So the first one is the market risk. What is the market risk? Market risk is the risk of possible changes in the price of key production materials. Okay, you know. So just like recently, we have, due to the removal of fuel subsidy and floating of the exchange rate, which has caused most of the things to continue to increase in which has resulted into increase in prices of goods and services. Now, the impact will be that if this is not well managed, if this is not well managed, it could lead to complaints. It could lead to complaints. It will lead to increase in production costs of complaints, right? And when there is increase in production cost, the only way that can be recovered is through increase in prices or increase in price of that item that is being produced. And because of the law of demand and supply, when there is increase in price, it will directly lead to a fall in the number of quantities demanded of that product. Now, let me give you a very good example. Many businesses have come to say that, including cement distributors, they've come to say that the reason why they have to also increase the prices of their goods is because the current one that they bought at a very low price, at maybe at a particular price, those ones that they bought at that price, if they refuse, because the price has changed from the producer, the price has changed from the producer, maybe down the value chain, the price has changed. If the distributor or if the retailers refuse to change their price, to increase the price, they will find it difficult after they have sold their current stock. They will find it difficult to buy to restock because prices have changed. Most of the time, prices get to be doubled. So they will have to, that means they will have to go and raise additional capital. What if they can't raise, they don't have access to additional capital? That means they are already out of the business. Or better still, they will be buying less than the number of quantities they usually buy. Okay. So market risk is one of the risks that affects many businesses and could make many businesses go out of business and will make them not to achieve their business objective. The other risk is known as the credit risk. What is credit risk? The risk that the risk that okay, let me use an example. So as a as as a supplier, maybe a supplier, you are you are supplying to your customers on credit. But there is a tiny chance, there is a chance that some of the credit that you have given to your customers might not be paid. That is credit risk. The risk that there could be losses from debts by customers or from customers repaying their debts. There could be losses. A customer could die, a customer could go bankrupt, and you not be able to recover maybe all of the debt owed by that customer. That is what is known as credit risk. There is also liquidity risk. Liquidity risk is a risk that, as a business, though you give credit to customer, you also, because you have those who supply it, you supply you too, and you are being supplied on credit as well. So the possibility that due to one reason or the other, you might not be able to pay your creditors as at when the credit fall due. That is that is liquidity risk. The risk that the cash available, the working capital available might not be able to settle the debt you are owing your own supplier. That is liquidity risk. And liquidity risk is one of the one of the risks that usually lead to end of businesses. Because if you fail, if you are unable to pay the debt you owe, the business you are owing will file for your business to be liquidated so that they can get their money, right? And that is the end of the business. So there's also technological risk. The risk that the changes in technology, the risk from changes in technology, and this is how it will affect businesses. If the change, if there is a change in technology, there's risk that as a business, if you adopt the change very quickly, if you adopt the change very quickly, um you know, you might be spending too much and the technology might not be required after all later on. Okay, that there's a risk that exists like that, right? And if you now decide that, okay, let me just sit back and watch others engage in, use the technology first before we invest in it, there's also the risk that when they do so, they will take the market share, they will take all of your customers away. So that is the idea behind technological risk. Okay, all right. And there's legal risk, and the legal risk is the risk that will arise from losses from failure failure to comply with laws and regulation. You know, if you fail to file your tax at the appropriate time, you could pay fine with interest. You could pay fine and interest. Those are legal risk. Okay, there's health, safety, and environmental risk. The health and safety risk is the risk that risk to the health and safety of employees. There's the risk that employees might be injured during the course of their work. Okay, and the business have to bear the that cost, right? And there's environmental risk, the risk arising from damage to the environment. So if there is damage to the environment, the company that caused the damage could be fined by the regulatory authority. So that fine is is a risk. And there could be reputational risk or reputation risk. A reputation risk is the risk that the reputation of the business could be damaged. And when the reputation of a business is damaged, that is the end of the business. Nobody will want to associate with such business. I can give you a very good example. I think towards the end of this is just a very good example we are all familiar with. Towards the end of 2023, there was this issue of the death of a Nigerian artist. They called the guy Mohbad or something, and that death was linked to somebody he has worked with, a colleague he has worked under before, who is what's his name? Um, Naira Marley. Yes. Now, after some time, what happened? Many radio stations, they started banning his songs. They banned his songs. That nobody, they no their stations will not play his songs. And at the end of the day, I think later on, he even released another song. After the whole saga died down a bit, he released a song. And after releasing the song on the internet, many people come out that we will not stream your song. We will not stream it. We will not listen to the song. That is a form of reputational damage because he was linked to the death of that artist, which resulted into a damage of his reputation. And many people disassociate themselves. Many organizations disassociate themselves from his business. There's business probity risk, and the risk that could arise from losses from failure of business to act in an honest way. So some businesses, they you know they buy their materials, they buy their goods at a particular price, but they make it to the public. They sell it to the public at another very exorbitant price, you know, which means that they are extorting the what? They are extorting the customers. So the risk is that when the customer get to know that they are being exhausted, I mean, extorted, so it could lead to a business property risk. That is, the business has not been acting or dealing with honesty and integrity. So these are examples of the common risk that are common to many businesses. Okay, these are those risks that are common to many businesses. Now let's look at another important thing under the um, risk management. Let's look at let's look at the nature between I mean the nature of business and financial risk. So what is business risk? Business risk is any exposure a company or organization has to face that may lower its profit or cause it to go bankrupt. So a very good example is Yes. Let's say Dangote Group diversifying into starting refinery, diversifying into oil and gas. You know that the business has invested billions of dollars in that business. Business risk is saying that whatever could make that business to fail, those issues, those events that could make the oil production to fail is known as business risk. Of course, if Dangote today, if anything happens, let's say in case of fire outbreak, and that Dangote refinery is burnt down, what will happen? That could impact on the Dangote Group business. And that could make the Dangote Group business to go bankrupt because some of the funds, in fact, most of the funds used in diversifying into business were gotten from loan, which means they will have to be paying back the loan. And most of the loan are even in dollar. And now that the exchange rate is very high, that means they will now need more naira to pay back what? The dollar loan. You can see that that could make the business, the Dangote Group business, to go bankrupt. That is business risk. Financial risk, on the other hand, is the risk that the the business could lose money in a particular investment, or that there is possibility that the business might not have enough cash flow to meet up its obligation. That is financial risk. So financial risk is most of the time the major cause of business risk. The financial risk that if Dangote refinery is burnt down today and they will have to repay the dollar loan, there is possibility of financial risk that there may not be enough cash. There may not be enough cash to pay back the loan, and that will lead to, you know, business risk. So that is why financial risk is the major cause of business risk. Okay. All right. So let's look at some concepts, some concepts in risk management. Let's look at certain concepts in risk management. The first one here, the first one here is exposure to risk. Exposure to risk. And the exposure to risk is when exposure to risk means that exposure to risk implies that the the possible loss an organization could face in a particular business. Okay, so let's look at this example. A Nigerian company that holds $2 million dollars is exposed to a risk of a fall in value of dollar against naira, because the naira value of the dollar will fall. Okay, so exposure to risk means that means that what that value of investment that you hold, you could likely lose a percentage of that money. So there is difference between what I'm trying to clarify is that If you are exposed to a risk of 100 million naira when you purchase a shares, that does not mean that you will lose 100 million naira if negative things happen. If the business goes wrong, that does not mean you will lose the 100 million naira. Exposure to risk means that you will only lose a percentage of that money you have invested. That is the meaning of exposure to risk. Then let's look at residual risk. Okay, the idea behind residual risk is that after you must have identified a risk and you have devised certain controls, you have put certain controls in place to mitigate the possible impact of the risk. You have, and the idea behind residual risk again is the fact that risk cannot be eliminated totally. You cannot eliminate risk totally. Okay, that is not possible. So there will always be, after you must have put certain measures in place to limit or reduce the impact of the risk, there will still be an element of that risk. The remaining element is known as residual risk. Okay, is known as residual risk. So let me use this example. So yes, yes, a company, a customer is owing you 500,000 naira, and that means you are exposed to this credit risk of 500,000 naira. Now, if you put certain measures in place, maybe you have put measures to remind customers about their debt, to give them period of repayment and all that. You have put all those measures in place, but there is still an element of risk that even though they pay that amount, they might still default. They might still be unable to recover certain percentage of that money. That is the residual risk that the company is exposed to. That is residual risk. Then let's look at risk appetite. Risk appetite is the amount of risk that the board of directors and the management are willing to take. That is appetite. You know, how much risk are they willing to take? The amount of capital that a trader is willing to lose or to generate in order to generate a particular profit. That is the risk appetite. The percentage of that amount of investment that they are willing to lose, that is risk appetite. Some companies, their appetite might be high. They might even be willing to lose half of the investment. Maybe that is not true. Maybe, you know, they are they are risk takers. They are ready to lose so much. We could talk about gamblers, those who gamble, right? So they have high risk appetite. They have high risk because they are willing to lose 100% of their stake so that they can make times two of that money, right? That is risk appetite. How much you are willing to lose in order to make profit. The risk averse is, it means that, you know if you are a risk taker, it's just the opposite of risk appetite. You have risk appetite, you are willing to take risk. Risk averse means that you do not you you don't want to lose any part of your money, any part of your investment, and as such you will avoid going into that particular business entirely because there is risk involved in the business. That is risk aversion. Tendency or preference of an individual or organization to avoid or minimize exposure to risky or uncertainty or certain situations. That is being risk averse. Then there's risk tolerance. There's risk tolerance. And risk tolerance refers to the willingness, or ability to accept or bear the potential risk and uncertainty associated with an investment or decision. It is the degree or percentage of risk that an individual or organization is comfortable with and willing to take in order to pursue uh, their goals. So, what is the percentage of that risk that they are willing to take to pursue their business goal? That is risk uh, tolerance. They tolerate risk. The degree to which they tolerate risk, that is risk tolerance. Now, let's look at the board policy on risk. The board policy on risk means that what is the board policy, is the board uh does the board have appetite for risk, or which means uh is the board willing to take risk in order to make profit for the business? So what that means is that the board have to decide at the top. They have to make a position at the top, and that position will either be when they are when the board have appetite for risk, or they are risk averse, you know or they do not want to take risk. So whatever their position is, whatever the position of the board is, they have to communicate this position to the management team, because if not, if this position is not made and is not communicated, that means the management are the ones that execute the the plan of the board. The board just make the plan. They make the plan. It is management that will break down the plan and execute it and turn it into action. So if the board policy on risk is not communicated to them, or is not even done at all, that means the, the management team will be doing what they like. If the board is risk averse and they do not make that known to the management, going into risky, I will be making is used to describe basically risk management process. That is management decision that involve management. The process of making management decision, which also include risk management process, that is risk-based approach. A very good example, when a company says that, yes, we want to invest in a particular business, but before making that investment, there's need for investment appraiser. And for the investment appraiser, every investment that is to be undertaken by the company, we use must have a positive net present value. So any business investment that the net present value is negative should not be undertaken. This process of appraising investment before being undertaken is known as a risk-based approach. Is known as a risk-based approach. That's just a simple um, you know explanation for what risk-based approach is. An approach to business decision that has to involve risk management. You identify the risk, you assess it, and you make the decision based on the assessment of the risk involved in the business process. Okay. All right. So hello.
Hi.
Hello, are you there?
Yes, sir.
All right. So I want to give 10 minutes for questions. For questions. Okay? So I want us to stop here today. So I want to give us uh just 10 minutes for questions. If we have any question, let's stop here today. All right. I'm with you. Any question? Any question? Adeyinka, Kayode, Hosanna. Any question? Yes, Adeyinka, you have a question.
Good morning, sir.
Good morning. You are welcome.
Yes, sir. You might need to that corporate governance about risk, shareholders' responsibility in instituting internal control measures.
Okay.
Can you shed more light on that aspect, sir?
Shareholders.
Hello, sir.
Hello? Come
Yes,
again.
sir. I said
Hello, come again.
the internal, shareholders' responsibility in making sure there is a strong internal control in the organization. Can you shed more light on that regard, sir?
Oh, okay. Okay. I think I get what you are saying. All right. So I was saying that, large companies like Dangote Group, there are lots of shareholders. There are lots of shareholders, and many of them do not even have business ideas. I mean, they don't have the skill to manage business, you know. So, so that comes the issue of separation of ownership from control, right? So there's separation of ownership control, which means that you will see that most of the owners are not usually those who manage the business. The owners are not. Those who manage the business are regarded as the board of directors, and they are given, of course, the owner. If you own something, you should control it. Even from there must be ownership and control. If you own a car, you control the use of the car, right? But you own the business in this case, you are not in control of the business. So who are in the control? Who are those in control? They are the board of directors. Becomes the owners will now be like, oh, our money that we have invested in this business, we are not the one that will manage it. We are not the one that are controlling it. It's the directors. What if they mismanage our money? What if they are stealing our money? What if they are engaging in businesses that we ourselves, if we are to be in control, will not be engaging in? What if they are doing those things? What if they are even paying themselves too much? We'll talk about that later. That is directors' remuneration. We'll talk about that later. So, for these issues to be solved, these are the possible issues. But for these issues to be solved, that is why we have the code of corporate governance. That is why we have what we know as corporate governance. Okay. Now, part of the corporate governance is that whatever business that the directors want to go into. For instance, before the directors of Dangote Group go into the oil production, into oil manufacturing and production and all that, they must sit down to identify those risks that could go wrong. So we could think about those possible risks. The possible risk will be that if the if there is a recently there's this idea that due to climate change, many businesses are now saying they are going green. That means they want to reduce their carbon emission, right? And many countries are now saying that, okay, for us to reduce carbon emission, we have to reduce the usage of uh, um, generators, vehicles that use petrol and diesel and all that, right? And that is why we are having electric vehicles. Now, one of the risks that they would have identified would be that what if in Nigeria, and in some African countries that they want to sell their products to, what if they start using what if they start using electric vehicles? What will happen to the business? The business is dead. The business is already dead. So they will have to at that point look for ways to manage it. So what if that happens? Then maybe there are other nations of the world that will still need their product. They will start selling to that part of the world, or those parts of the world. Okay. So the one of their responsibilities is they must they must they must identify risk in businesses that they are going into. And not only that, even in the current business that they are doing, that they are into, they must also identify and manage the risk. They must identify the current risk. They must identify the potential risk, the future risk, and make sure that they formulate internal controls to reduce the impact of the risk, to manage the risk. And they must produce a report. They must produce a report alongside the annual report. They must produce a report on risk management, on how they have identified and managed risk that the organization is exposed to. I hope I've answered your question. That's a fantastic question.
Hello, sir. So this
Hello?
is Kaidi.
Okay.
Yes, sir. So if corporate governance actually refers to um the uh distinction between, having this clear distinction between the managers, the ownership of the business and those that manages the business.
Okay.
Now, is it a general, what is the general standard like? I've seen corporations, I've seen organizations that the board, the board of directors, we have